What is passive investing and when should you be a passive investor? Hey, Small Axe community, it's your boy Nico. This show is dedicated to helping you use your small axe to build a personal empire. So, on this show, I'm going to share some real, raw, behind the scenes info that's going to help you build your own multifamily portfolio. So, if you enjoy this show, I would love it if you could share it with somebody that you think could get value from it and write a review. It's the only way that we can grow this thing. Now, let's get to work. Let's jump into this episode and start sharpening those axes. All right, let's jump right into this. So, passive investing is when you put your capital, your money, your resources into something that is going to pay you dividends or income regularly with little to no work on your end. That's passive investing. Now, I focus primarily on real estate investing, which in this scenario, we would have a syndication. And you would be investing your capital into a syndication. You're not really investing much time or other resources other than your capital. So your money is going to be invested as a limited partner in a syndication with general partners, the sponsorship team. Now, month over month or quarterly or perhaps yearly, you're going to be getting what's called mailbox money. You're not doing any work. You're sitting at home. You're just observing and watching how the property is performing. You're getting a weekly, monthly, quarterly, annually, whatever it is, updates on the property's performance, and you're getting a check in the mail or this day and age, a wire getting sent to you regularly. That is a return on the capital that you invested. Now, the general partner is on the other side. They're on the active side of this equation. I am a general partner as well as a limited partner, passive investor. However, I spend the majority of my time on the active side. Therefore, I am an active investor. Now, many limited partners or passive investors are also active investors in other parts of their career. So let's distinguish active investing, people who are doing work day to day, overseeing the asset, overseeing the project, overseeing whatever the investment is, whether that be crypto, whether that be stocks, bonds, whatever. But in my case and in our scenario, we're talking about real estate. The active investor oversees the day to day. Okay, they are constantly involved in making decisions, talking about how to lease better, what to renovate, what's quality to renovate to, what standards, what capex items need to be taken care of now, some preemptive and proactive measures to make sure the property is going to have long lasting life, and talking about when we're going to be refinancing, perhaps selling. What about insurance rates? What about talking and getting bids for different materials, different insurance, different expenses, et cetera, and always trying to reduce those costs to enhance the cash flow, to enhance the property value, the NOI, and overall your investment as a limited partner. The limited partner, the true passive investor, has some work to do. We can't call it zero. The first and most important work for this limited partner / passive investor, if you are considering investing passively, is to, number one, understand what real estate is. Understand what a syndication is. You have to have some knowledge. You can't go in blind and just put your money in with an operator. You can't do that. You first have to have some background. What is passive investing? It is putting your money and trusting with a team that a real estate project is going to perform well based on that team's ability to make it perform well on their business plan. So you have to understand what a syndication is. You have to understand the basics of investing in real estate, and you have to then vet the team that you're going to be working with, as well as the market and the property. So there is work up front prior to putting your money into a syndication. If you're ready to passively invest, you have to know basics of real estate. You have to know the team that you're getting involved with. You have to know the property and the market. Once you are, and if you need help with any of that, I help people all the time with understanding that. I even review deals with people to help them understand whether or not it's a good investment and whether or not they should be investing passively. Now, for those people that are ready to passively invest, what do you need? What is the next steps? Well, you need capital. Okay, so I want to clarify this. You can't just be a passive investor with no resources, no capital. You have to have money. The majority of syndications accept a minimum of a $50,000 investment. So you have to have $50,000 sitting in the bank minimum in order to consider being a passive investor. Very important. You can't just be a passive investor with $1,000, with $500. I mean, look, there are ways to do it. There are different avenues to go this day and age, but in a traditional syndication, the real way to do it and the real way to earn capital or have your capital pay you is through investing a minimum of $50,000 in a deal. And if you're not ready for that, if you don't have that, or if it's your last 50,000 and you scrambled, you have 49,000 and you don't have anything else anywhere else in your life, you need to rethink being a passive investor. The main idea with passive investing is having a bunch of money working for you, paying you a return. My ideal scenario is 1.5 to $2 million in passive investments working for me. That's my personal ideal scenario because I worked out that at a 6 to 8% return, I'm going to be getting $10,000 a month on that return. You need to work out something similar for yourself. So figure out how much money you can backtrack it if you want to go full on with passive investing. You can backtrack and be like, all right, I need $3 million to make $150,000 a year or whatever it is. Figure it out on your own. But for me personally, 1.5 million to $2 million at a 6 to 8% return will get me where I need to be to retire. But that's not everybody's goal. You have to consider what your goal is with your passive investment. For example, if you have $75,000 sitting in the bank and you're ready to invest $50,000, that's pretty safe. You can take your $50,000, invest it with a trusted operator in a market that you have vetted, in a deal that you have vetted, and you're ready to invest. You put that $50,000 in with the hopes that it will double in 5 years. That's the typical scenario. Along and throughout this time, it's going to be paying you some sort of dividends, monthly, quarterly, biannually, whatever. It should be paying you as well, unless it's a ground up development or something like that, or certain circumstances where they don't pay you dividends. And that's acceptable too, but you have to understand what you're getting into. And then you take that and you flip it. So 5 years from now, your $50,000 is now $100,000. You take that and you reinvest it in another deal for 5 years now from that point to become $200,000. So now your $50,000 in 10 years is $200,000. That's the general premise. That's the general idea with passive investing. And all you're doing upfront is vetting the partners, the people that you're going to be working with and putting your money with, the team, the general partnership team. You're vetting the property, you're vetting the market. Okay. And if you need help with any of this, again, I am here to help. So the active members perform daily. They're working on this project, the property daily. They communicate with you, the passive investor who's getting that mailbox money sent to them for doing nothing other than vetting up front, okay, and monitoring. So you monitor throughout the hold period. You're just monitoring. You're not really having any input. You have limited say on what happens anyway, but your money is expected to grow. Okay, so it might take 2 years. And a few years ago, it was taking a year or two to double your money, and people were cashing out and doubling their money in 2 years, getting crazy IRRs. That's not the case right now. So perhaps now it takes 5 to 7 years to double your money. That's okay. You still need to have your money working for you. It's important to understand that as a passive investor, you need to consider the fact that your money is just there. It's working for you. You're not getting paid off it necessarily if it's a $50,000. You're not living off it, rather. If it's a $50,000 investment, you're not going to live off that. There's no possible way to live off that $50,000 investment unless you're getting 30, 40% returns compound monthly. It's just not possible. Again, there are outliers, but let's take the standard, the typical 6 to 8% return on your investment. You're not living off of a $50,000 investment. The objective for the $50,000 investor is to double that every 5 years. Think about it that way. Now, if you have multiple $50,000 investments in multiple projects and you double them every 5 years, you could reach your end goal of $1.5 to $2 million in, let's say, 10 to 15 years. You got to think about it on the long term. You got to think about it for the long run. So, is it beneficial to even invest as a passive investor? 100%. What is your money doing otherwise? Your money is sitting in the bank, getting very little return on it, and inflation is eating it up. You need to have it being in a deal working for you. You really should, whether that be any type of investment, stocks, bonds, crypto, whatever you think, but also real estate, because that money in real estate over time has historically appreciated 8% ish or better. I don't know. I got to relook at this. All right, I just took a peek at it. I just Googled it. I AI'd it, and ChatGPT says 7 to 9% historical is the return that you're going to get on multifamily real estate. So, boom, there you go. You have to understand that 7 to 9% is beating inflation. It is increasing your money's value, and it's paying you a little bit of money. Maybe it pays your cell phone bill for the month. That's awesome. You got to think about it like that. Then in 5 years, that money doubles. You reinvest it, it doubles again 5 years later. These are the goals that you want to have as a passive investor. Now, for those people out there that are looking to retire off their passive investments, remember, backtrack it. Make sure you know exactly how much money you need to invest to get that 6 to 8% return annually. So for me, again, 1.5 to 2 million will get me $10,000 a month. Now, do you invest with one operator? Maybe. One project? No. So you're not going to put $1.5 million or $2 million in one project unless you have tens of millions of dollars. That's just not the wise way to do it. You want to spread your money out a little bit because there are scenarios and circumstances where deals don't perform. That's normal, guys. Don't get freaked out if you come across that. It's normal, especially in the market cycle like today. We're in a down cycle. It's okay. As long as your deal is afloat and working, and if you're still getting a dividend today, you're still getting payments monthly or quarterly, that's a win. So if I had $2 million, I would probably invest in 4, 5 projects, 6 projects, maybe even 7, depending on how much you want to put. You want to spread that wealth around. If I have that many operators and that many deals that I find that are good and I think are good, I would invest that amount, maybe $200 to $300 per $200,000 to $300,000 per investment. Now, back to what we were originally had intended on discussing. What is passive investing and when should you be doing it? A quick distinction: passive investing, you're doing little to no work. You're just vetting the property, the general partnership team, the market up front. Then you sit back and watch. Active investing, you're doing the day-to-day work. You're making sure the property hits its business plan and performs to its business plan. Okay. When should you be passive investing? Always. Even as a general partner, me, an active investor, I put my money on the passive investing side, whether it be with my projects or with other people's projects. Why? Just as I said before, you're not going to live off that income. If you have $50,000 at an 8% return, you're not living off that. It's only a few $100s a month. You can use that to pay certain bills, or you can compound that, stack it back, and use it to reinvest. Okay. You're just thinking that money's going to double over the course of 5 years. So think about it as your retirement plan. Think about it as your long-term plan for your kids. Maybe this is going to be their college fund. Maybe it's going to be your retirement home. Think about it that way. Unless you're putting in a lot of capital, hundreds of thousands of dollars to invest, you're not, and even 1.5 to 2 million or more, unless you're putting that amount in to invest, you're not going to live off the returns, but you can still benefit from those returns. So when should you be passive investing? Always. Even all the general partners, all the active investors that I know are still at the same time passive investing in deals. Extremely important to do both, extremely important to do passive investing. Whether you want to be an active investor or not is a whole other topic and a whole nother ball game. And I talk about active investing and the challenges that come with it all the time. It might not be for you, especially if you have a W-2 like I do. It is an excruciating amount of work and stress involved with what's going on behind the scenes. So consider the fact that you should be at least passive investing and then potentially active investing as well. Passive investing, little to no work. You put your money in a syndication, you vet the team, the property, the market up front, you sit back and collect mailbox money. When should you do it? All the time. Always be putting your money into passive investments. Once you have your next 50K, however you get it, whether it be through savings or however, you put that money to work for you. If you have less than 50K, consider the fact that maybe you should wait and hold off. If you have hundreds of thousands of dollars, speak with me or somebody that can help you distinguish which properties and teams to be putting your money with. All right. So for the meantime, make sure you're still vetting properties, teams, and markets to know that You want to be investing passively at some point if you're not doing so already. If it's your first passive investment, I highly recommend you speaking with me or somebody that is knowledgeable in the space. If it's your 50th passive investment, contact me ASAP. I have some deals ready for you. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.